The last few years, artificial intelligence has been the biggest story in technology. Companies have spent billions of dollars. Investors have poured money into AI-related businesses. Data centers have expanded at a record pace. Technology executives mention AI in nearly every earnings call, and some of the world's largest companies have reorganized entire strategies around the technology. The excitement has been extraordinary. In many ways, AI has become the center of Silicon Valley, but every boom creates an important question. What happens if growth slows down? What happens if businesses adopt AI more slowly than expected? What happens if spending starts cooling? And what happens if the technology takes longer to generate returns than investors currently anticipate? It's a question more people are beginning to ask, not because AI is disappearing, but because history shows that every major technology wave eventually faces a reality check. The internet experienced one, smartphones experienced one, cloud computing experienced one, and AI may eventually face one too. The first thing to understand is that a slowdown wouldn't necessarily mean failure. Those are two very different things. A technology can be incredibly important and still experience slower growth than expected. The internet transformed the world, but many internet companies failed during the process. Cloud computing became essential, but adoption took years. The same could happen with AI. The technology may continue advancing while business expectations adjust. That's a scenario many analysts are watching closely. One reason a slowdown could occur is cost. Building AI infrastructure is incredibly expensive. Companies are spending hundreds of billions of dollars on data centers, computing equipment, networking systems, and power infrastructure. Those investments are based on expectations of future demand. If demand grows more slowly than anticipated, companies may begin asking difficult questions. Are the returns arriving fast enough? Are customers adopting AI products at the expected pace? Are the investments generating sufficient value? Those questions become increasingly important as spending grows. Another factor is productivity. Much of the excitement surrounding AI is based on the belief that it will make businesses more efficient. Workflows could improve, tasks could become faster, operations could become more productive, but productivity gains are sometimes difficult to measure. Companies may need years to fully integrate AI into their operations. If benefits take longer to appear, enthusiasm could cool temporarily. That doesn't mean the technology lacks value. It simply means business adoption may take longer than investors expected. History shows that large organizations rarely change overnight. Infrastructure would likely be one of the first areas affected by a slowdown. Today, technology companies are racing to build capacity, new data centers, new computing systems, new energy infrastructure. The assumption is that future demand will justify current investments. If growth slows, some companies may delay expansion plans. Instead of building aggressively, they may become more selective. The result could be slower spending throughout parts of the technology sector. Investors would pay close attention to that shift. Stock markets are another important piece of the story. Much of the excitement surrounding AI has influenced valuations across the technology industry. Investors often price companies based on future expectations. When expectations rise, valuations often rise as well. But if growth slows, expectations can change. That doesn't mean companies suddenly become weak businesses. It simply means investors may reassess how quickly future profits will arrive. Markets frequently go through these adjustment periods. They are a normal part of emerging technology cycles. Some companies would likely be affected more than others. Businesses generating revenue directly from AI products may face greater scrutiny. Investors would want evidence that customers are willing to pay for services, that business models are sustainable, and that long-term demand remains strong. Companies unable to demonstrate those things could face challenges. Meanwhile, firms with diversified revenue streams might experience less pressure. The strongest businesses often perform well, even during periods of uncertainty. What's interesting is that a slowdown could actually benefit parts of the industry. During technology booms, enormous attention often focuses on growth. During slower periods, attention shifts toward efficiency. Companies become more disciplined, investments become more targeted, and businesses focus more heavily on practical applications. That process can strengthen industries over time. Some of the most successful technology companies emerged stronger after periods of adjustment. Another possibility is that the AI boom evolves rather than slows. The current phase is heavily focused on infrastructure, data centers, computing power, and large-scale investment. Future phases may focus more on practical applications, how businesses use AI, how consumers use AI, and how industries integrate AI into everyday operations. In that scenario, growth continues but shifts to different areas. The headlines may become less dramatic, yet the technology could continue spreading throughout the economy. That's happened before with other innovations. Perhaps the most important thing to remember is that technology revolutions rarely follow straight lines. Progress happens in waves, periods of excitement, periods of adjustment, periods of renewed growth. The internet followed that pattern. Mobile technology followed that pattern. Cloud computing followed that pattern. AI will likely follow its own version as well. The biggest mistake is assuming that every slowdown signals the end of a trend. Often, it simply marks the transition to a new stage. The companies best positioned for that transition are usually the ones focused on long-term value rather than short-term excitement. They continue building, continue improving products, and continue solving real problems. Those businesses often emerge stronger when the market becomes more selective. So what happens if the AI boom slows down? Infrastructure spending may moderate, investors may become more cautious, companies may face greater pressure to demonstrate results, and markets may adjust expectations. But none of that necessarily means AI is failing. It may simply mean the industry is moving from hype toward reality, from experimentation toward practical adoption, and from big promises toward measurable results. In many ways, that transition could be healthy, because the technologies that truly change the world aren't usually the ones that generate the most excitement. They're the ones that continue creating value long after the excitement fades. And if AI can do that, then even a slowdown may not stop its long-term impact. It may simply be the next chapter in one of the most important technology stories of our time.